In this VITA Advanced Tax Topic video, we will be expanding on what we learned in the basic video for the retirement income lesson of IRS Publication 4491. We will be learning how to calculate the taxable portion of a distribution where the taxable portion has not already been determined. We will also be learning about required minimum distributions, qualified charitable distributions, and the exclusion for public safety officers. So thinking back to our basic lesson on retirement income, our taxpayers are going to come to us with a 1099-R, R for retirement, or RRB 1099-R, which is a railroad retirement. Many times the taxpayer will bring the form and the taxable amount will already be determined on that form with an amount showing in box 2, and we can just enter the information directly as it appears on the form. But sometimes the taxable amount has not been determined, and that leaves us to figure out what amount of this distribution is going to be taxable. Thinking back again to our basic video, taxpayers may have contributed money into retirement benefit plans without paying tax first. In this case, the whole distribution would be taxable. However, taxpayers may also have contributed money into these accounts that was already taxed. In this case, it would not be fair to tax them on the same money twice. So to avoid double taxation, we might need to use a calculation known as the simplified method to find the correct taxable portion attributable to this year's distributions. To recap what our Form 1099-R is going to look like when the taxable amount is not determined, Box 1 will have the gross distribution. Box 2A might be a 0 or it might be blank, and there would be an amount shown in Box 9B. Box 2A is the taxable amount, and Box 9B is the employee's contributions to the plan, or the employee's cost. Another way we might find that the taxable amount needs to be determined is if Box 1 and Box 2A have the same amount and Box 2B is checked for taxable amount not determined. And we really didn't look at this form, the form RRB 1099-R, for our Tier 2 railroad benefits in our basic lesson because the taxable amount has never been predetermined for this form. And as we discussed before, this is an advanced topic, so it requires advanced certification to determine the taxable amount. So looking at this form, you can see that we have some boxes and they kind of relate back to some of our 1099-R boxes. So you can see there in box 3, we have our employee contributions. That's just like the 1099-R box 9B. And then in box 7, we have the total gross paid. That's like our 1099-R box 1 gross distribution. And then federal income tax withheld, you'll see that that is box 9. That is the same as 1099-R box 4. And then there's a little box there down at the bottom, box 12 was the Medicare premium paid. And that would be something that flows to Schedule A if we have a taxpayer who is itemizing their deductions. Itemizing deductions is an advanced topic that we'll talk about in a few lessons, so don't worry if you're not knowing what's going to happen there. In order to calculate the taxable amount using the simplified method, we're going to need some additional information from our taxpayers. We need to know their cost in the plan, if it isn't already on the form. We need to know the taxpayer's age. That's the date. That's on the date that the annuity began, not their age at the end of the tax year. And this can sometimes trip you up. So it's important to remember that this is their age when they started receiving payments. And then we need to know the tax-free amounts that they have already recovered in previous years. The total employee contribution on Forms 1099-R or RRB 1099-R is the cost in the plan. As we just discussed, we need to figure out the taxpayer's age on the date the annuity or the payment started. We also need to note whether the annuity started before or after the taxpayer's birthday that year. So it's really important that we are talking with our taxpayers to figure this out. We need some input. And then there are what are called joint and survivor annuities, which are types of plans where if the owner of the plan passes away, the spouse continues to receive payments. If we are looking at that type of plan, we will add the spouse's ages. Now remember, that's their ages when they first started receiving payments. And then we need to know the previously recovered tax-free amount. With the simplified method, a portion of the taxpayer's cost will be allocated to the distribution as a non-taxable part of that distribution. Whatever amount of cost that is left will be allocated to future distributions in future years. So we need to know what they have already recovered as a tax-free amount. This is available from the taxpayer's previous year return in a worksheet, which we'll look at in a couple of slides. Sometimes, though, our taxpayers don't bring in their prior year return, or they don't know how much they've recovered. If that happens, then we can multiply the monthly tax-free amount from our calculation by the number of months they have been receiving payments prior to the current tax year. So now I know you're wondering, how on earth do I figure out the monthly tax-free amount? So that's just the taxpayer's cost basis. So, that's the employee's contribution into the plan, divided by the number of monthly payments, and that comes from a table, which we'll look at shortly, and that equals the monthly tax-free portion. So it's important to remember that's the tax-free portion. The taxable portion would be the total distribution minus the tax-free portion would equal the taxable portion. And the IRS kindly made us a worksheet to help us figure out the taxable amount using the simplified method. It's called the Simplified Method Worksheet. You can find this in Publication 575. Also, if we are inputting information correctly into TaxSlayer, the software will automatically generate this worksheet for us, so we don't necessarily need to look up the worksheet unless we need to determine what amounts were previously recovered. In that case, the reason why you would want to look up the worksheet is because at the bottom of the worksheet is a table that helps you know, based on the taxpayer's age at the annuity start date, how many months to spread the taxpayer's cost over. Remember, our calculation is the total employee's contribution, that's box 9B of 1099-R, divided by the number of months, which is the number these tables give us. That will tell you what the monthly tax-free amount is. Then you can multiply the monthly tax-free amount by the number of months they received payments prior to the current tax year. And as I said before, the worksheet is in TaxSlayer. On the 1099-R input screen, you will enter box 1 for the gross distribution. Then, as you tab to the next input field, TaxSlayer will automatically fill in box 2A. Don't enter anything into box 2A, or it will override the calculation you are about to do. Instead, just under is a question. Do you need to calculate your taxable amount? With a link. Click on the link to get to the simplified method worksheet inputs. Once we've clicked on the link for the simplified method worksheet, we'll have another page with a menu come up with just a couple of options. We'll calculate the taxable amount using the simplified method worksheet. There's also this public safety officer's distribution. We'll talk a little bit more about what that is in a few slides. But if we're using the simplified method, we're wanting to click on that simplified method worksheet to begin that. And then we'll get a notification that pops up, the simplified method qualification. And so there are some criteria that our taxpayers have to meet. They most likely will meet these in order to use the simplified method. They have to use the simplified method if the starting date of the payments were after July 1st of 1986 and they used the simplified method last year. If they started receiving payments after November 18th of 1996 and they were under the age of 75 and entitled to less than 5 years of guaranteed payments, then they must use the simplified method. They can use the simplified method if the payments were from a qualified employee plan, a qualified employee annuity, a tax-sheltered annuity plan, such as a 403B plan. So these are all tax-sheltered kinds of accounts that people had been putting money into. And then if they were under age 75 at the annuity starting date, or they were entitled to less than 5 years of guaranteed payments, then they are also eligible to use the simplified method worksheet. They cannot use the simplified method if this is from a non-qualified plan or they don't meet the requirements that we just kind of went through. Then they have to use what's called the general rule. And if they need to use the general rule, then that return is going to be out of scope for us. So, but we don't run into that very often. Most people are going to qualify to use the simplified method. Once we've determined that our taxpayers qualify to use the simplified method, we hit continue and TaxSlayer pulls up the input screen. You can see TaxSlayer auto-populates gross distribution amount. We enter the plan cost at the annuity start date, remember box 9B from 1099-R or box 3 of the RRB 1099-R. Then you enter the starting date of the annuity, so whenever the payments began. Check the box if this is a joint or survivor annuity and enter the taxpayer's age at the start of the annuity, or if this is a joint or survivor annuity, add the spouse's ages. A little further down, there is a field for how many months were paid in the current tax year. Unless the payments just started in the current year, this would be 12. And down from there, there's an input for the previous tax-free amounts taken. Now that we've discussed how to use the simplified method to calculate the taxable amount of the distribution, we have just a couple more small topics to talk about. The first is required minimum distributions, or RMDs. These are required to avoid an excess accumulation of money in a tax-favored account. The plan administrator should notify the taxpayer when they reach the age that these funds need to be taken. For taxpayers whose 70th birthday was before the 1st of July 2019, this would have been when they reached 70 and a half. For taxpayers whose 70th birthday was after that date, this would have been when they reached 72. However, in 2022, the Secure 2.0 Act raised the age again to 73 beginning in 2023. In the first year, there is a little grace period and taxpayers have through April of the next year to pull the money out before a penalty is assessed. After that, taxpayers must take the money out by the last day of December. If taxpayers don't take the required distribution amount out, a penalty tax of 50% of the difference between what they took out and what they should have taken will be applied. If we see taxpayers who are going to have this penalty, we need to refer them to a paid preparer to see if they can qualify for a waiver, Form 5329, Part 9, which is out of scope for our program. Qualified charitable distributions, or QCDs, are non-taxable distributions that are made directly by the trustee, or the organization that holds the account, to an organization that is eligible to receive tax-deductible contributions, like a 501c3 charitable institution. The taxpayer needs to be at least 70 and a half to do this. And importantly, it counts towards the taxpayer's required minimum distribution. QCDs can also be excluded from income. There are instructions on how to do this in IRS Publication 4012, so if you have a taxpayer with this situation, you will want to look up how to enter it. Lastly, the excludable amount will be reduced if the taxpayer is taking any deductions for IRA contributions. And finally, we have the exclusion from income for public safety officers. Officers include a law enforcement officer, a firefighter, a chaplain, or a member of a rescue squad or an ambulance crew. And these taxpayers may they can elect to exclude from their income up to $3,000 of distributions made directly from a government retirement plan to an insurance provider.